If you can understand this trick about how the market creates levels of support, then the charts will really come alive. Your ability to analyze the price action will go from here to here.
Support always forms in areas where people trade, where buyers meet sellers. In a bullish move, eventually people who bought the market want to take some profits, and traders on the wrong side finally give up and get out. The winners become sellers and the losers become buyers. This stops prices from continuing higher, and it's a dynamic which is going to create support in the market in the future. As the market then pulls back, traders who missed out on the initial move now see their opportunity to buy the market, and the cycle starts again. Prices now rally and break the highs. Our support structure is now formed. Therefore, as the market starts to trend higher, each time the market pulls back, we should expect the bulls to step in to support the price in that area, hence the term support. They should add to their positions to increase the amount of buying pressure for continued higher prices. So in our uptrend, by marking the peaks with a line, we're connecting the trend we're building with the prices that should act as our support points in the future. However, to take it to that next level, we need to connect support with the concept of demand. Also, keep watching because I'm going to show you a tip on how we can use support to help us gauge how strong the momentum in the market is. Connecting support with demand is a very simple concept. The market only turns because of the mass buying from lots of different traders all over the world. They may be collectively bullish, but they will all trade slightly differently at different times and prices. Some will want to get in fast and buy at support. Others may want to wait a little longer just to see if they can get a bargain. So you'll see that our peak may sometimes get broken, but only temporarily. This is the effect of the demand in that area on that support point. Therefore, we can have a support point at the peak, but if we draw a box over the peak into the first or second bearish candle at the turn, we create a demand zone. This is how we can create a robust price range to focus on. So let's look at a live example. This is the dollar against the yen on a 4-hour time frame, and you can see the nice uptrend that we've got forming. All I need to do is go in and just start marking these swing high points, and you'll start to see how that creates nice support points for our pullbacks when the market starts to retrace. Now, if we can add the demand zones in and just put those over the first bearish candle, this is where it's going to take a little practice and some experience to get good at doing this, because you're always going to have the odd outlier. So for example, here you can see we've pushed above the support point here. I could mark that, but really in theory all that's doing is expanding our area of demand. So it could be argued that maybe that one doesn't really need to be added in, but the others are certainly very valid. And so you can start to see that paints a really nice picture of where those support points should be in the market. And finally, here's a quick tip for you on how we can use this concept to help us gauge how strong the momentum in the market actually is. This is a pound yen chart, and once we breach the support point here and we trade higher, when we retrace back down, we don't even get back down to the support, let alone trade into the demand zone. So that tells you how bullish the price is, and you can see the market really pushes higher as a result of that. So, in conclusion, all you really need to remember is that the support is the level and the demand is the zone, but both work together to turn the price around.